Today, let's talk about the world's largest asset management company, BlackRock. BlackRock just became the first in its industry to have $10 trillion in assets under management. That's 10 trillion with a T, making the company a powerful player in the investing universe. Investing in BlackRock stock has been a winning long-term strategy. It's easily beaten the overall market the last 3, 5, and 10 years. And then there's the dividend, which has grown like a weed over the last decade, and which has been bolstered again by the 18.2% increase the company just announced. In this video, I'll discuss BlackRock's history and its business model, how it might appeal to dividend growth investors, and why I felt it was a good addition to our Income Builder portfolio. Hi everybody, Mike Nadell here for the Dividends and Income channel. Before I talk more about this outstanding company, please do us a favor to help us keep growing, okay? Hit the thumbs up at the bottom of the video, subscribe to our channel, and ring the bell so you get notifications of new videos as we publish them. Now let's get right into BlackRock. Their story began in New York City in 1988 when Larry Fink and 7 partners founded the company to provide institutional clients with asset management services. Larry Fink remains the company's CEO to this day. The business first formed under the umbrella of the Blackstone Group, and it mostly invested in large, financially strong companies while managing risk for its corporate clients. In 1992, that part of the company changed its name to BlackRock, and it broke away from Blackstone a few years later. In 1996, BlackRock introduced its first iShares exchange-traded fund products, the MSCI series of international ETFs. Each of those ETFs sought to track the investment results of an index composed of stocks from each country: Australia, Austria, Belgium, Canada, France, Germany, Hong Kong, Italy, Japan, Malaysia, Mexico, the Netherlands, Singapore, Spain, Sweden, Switzerland, and the United Kingdom. 1999 was a big year for BlackRock. That was the year it became a publicly traded company on the New York Stock Exchange under the ticker symbol BLK. It also was the year BlackRock began to sell its proprietary technology called Aladdin to institutional clients. Today, Aladdin is used not only by BlackRock themselves, but by hundreds of investment managers, pension funds, and insurers throughout the investment world. Then came May 15, 2000, when BlackRock debuted its first US-centric exchange-traded fund, iShares Core S&P 500 ETF. With its exposure to the index most accepted as a proxy to the overall stock market and its very low cost to investors, the fund was instantly popular. It's grown to be the second largest ETF offering out there, trailing only the Spider S&P 500 ETF Trust. A week after the S&P 500 ETF came out, BlackRock added several other options to its core series, including funds tied to the Small Cap Index, Mid Cap Index, Growth Index, and Value Index. Today, there are more than 800 iShares ETFs, with a combined assets under management of more than $3 trillion, accounting for about a third of BlackRock's $10 trillion AUM. During the first decade of the new millennium, BlackRock went on an acquisition spree, adding SSRM Holdings from MetLife, Merrill Lynch Investment Management, Barclays Global Investors, and R3 Capital Management. Those moves made BlackRock the world's largest asset manager. In 2011, BlackRock stock became part of the S&P 500 index, meaning the company itself was a holding in its own core ETF. BlackRock had operated a hedge fund for years, but in 2015 it got out of that business so it could concentrate on its core clientele, institutional and individual investors. That year it became the first in the industry to surpass $5 trillion in assets under management. In 2018, BlackRock launched its first AI lab in Palo Alto, California, to accelerate its use of artificial intelligence in asset management. In 2019, with 2/3 of its assets under management related to retirement planning, the company launched BlackRock Retirement Solutions Group. In 2020, BlackRock became the first global asset manager to get consent from the Chinese government to start operating in that country. Okay, now let's talk some more about what BlackRock's got going on today. Here's a description of the company's business strategy by Morningstar analyst Gregory Warren. Through its iShares exchange-traded fund platform and institutional index fund offerings, the wide moat firm sources 2/3 of its managed assets and close to half of annual revenue from passive products. The biggest differentiators for the firm are its scale, ability to offer both passive and active products, greater focus on institutional investors, strong brands, and reasonable fees. Thanks to iShares, BlackRock is by far the leading ETF provider in all of investing. BlackRock has earned a reputation as a high-quality business. Morningstar gives the company its highest grades, a wide moat rating that speaks to BlackRock's competitive economic advantages over its peers, and an exemplary rating for capital allocation, which represents outstanding management. Standard & Poor's gives the company a sparkling AA- credit rating. Value Line says it's financially strong and relatively safe, and Simply Safe Dividends bestows a near-perfect 98 score for dividend safety. On January 14th, BlackRock released its fourth quarter and full year 2021 earnings report, and it was a good one. Adjusted diluted earnings grew 16% for the full year to $39.20 per share. Full year revenue grew by an impressive 20%, including record organic growth, record performance fees, and continued growth in technology services revenue. Fourth quarter adjusted operating margin was a strong 45.5%. Despite those results, the stock actually pulled back about about 2% on the day of the earnings presentation, apparently because quarterly sales and operating margin just barely failed to meet analyst estimates. Nevertheless, the CEO, Larry Fink, was very happy with the report. He said, BlackRock delivered the strongest organic growth in our history, even as our assets under management reached new highs. We generated $540 billion of net inflows in 2021. Our industry-leading iShares ETF platform remained a significant growth driver with record flows of $306 billion. And our technology services businesses, powered by Aladdin, delivered $1.3 billion in revenue. BlackRock enters 2022 better positioned than ever. We remain confident in our ability to continue generating differentiated organic growth over the long term and helping more and more people experience financial well-being. Well, he would say that, wouldn't he? After all, he's BlackRock's CEO, and part of his job is touting what he considers great achievements in the face of the COVID pandemic, supply chain issues, inflation, and other headwinds. But I tend to agree with Mr. Fink that the company is operating at a high level. BlackRock leads its industry in numerous categories, has a winning software product for corporate clients in Aladdin, and offers so many ETFs that investors can stay in the family for everything if that's what they want to do. The small price pullback actually helped me decide to select BlackRock as the income builder portfolio's first buy of 2022. I executed a purchase order for one share at $846.51 on behalf of this channel's co-founder, Greg Patrick. We've now invested more money into BlackRock, $3,656, than we have in any of the IBP's other 45 positions. It's one of the portfolio's largest holdings by both market value and income production. And speaking of income, another big reason I chose BlackRock was its 18.2% dividend raise, the company's largest hike by percentage in more than a decade. And that's no small thing, because the dividend had increased 200% over the preceding 10 years. 2022 will be the 18th consecutive year that BlackRock will have paid a dividend without interruption or reduction, though it did freeze the payout for 1 year during the Great Recession. Meanwhile, BlackRock reiterated that it's aiming to buy back $1.5 billion of its stock in 2022, further adding to shareholder return. The company has repurchased $11 billion worth of stock since 2013, reducing the share count by 11%. All right, now let's talk briefly about how buyable BlackRock stock is. 14 of the 16 analysts monitored by Reuters have given BlackRock either a buy or outperform rating. Morningstar's analysts already were bullish, with a $910 fair value estimate, but after the most recent earnings report, they were even higher on the stock, saying, unlike most of the other traditional US-based asset managers we cover, we are projecting an improvement in BlackRock's operating profitability over the next 5 years. We expect to increase our fair value estimate for wide moat rated BlackRock to $960 per share. CFRA's analysts call the stock a strong buy and have a 12-month target price of $1,010. Value Line includes with BlackRock on its list of the 100 highest growth stocks. One of my favorite times to buy a stock is when Wall Street knocks it down despite the company having a good earnings report. An 18% dividend raise is a cherry on top. But even though Morningstar says BlackRock is undervalued, the stock isn't the same kind of bargain buy it was when we first made it part of the income builder portfolio in 2018. I can only hope the stock keeps performing at the same market-crushing rate. For more on the income builder portfolio, including the table of all 46 positions and links to every IBP-related article I've written, please click on the link in the description. Okay guys, that's all for today. Again, please give us a thumbs up, subscribe, and ring that notification bell so you don't miss out on any of our content. Take it easy everybody. Back at you soon.